Tom Jacobs is the co-author of What's Behind the Numbers, a guide to exposing financial chicanery and avoiding huge losses in your portfolio, something that we all appreciate as investors, as individual investors. Although today an investment advisor and money manager with Dallas's Echelon Investment Management and also the Motley Fool, he is a Rochester boy through and through. Born and raised in Pittsburgh, Tom attended Lincoln Avenue and Elm Creek Elementary and Mendon Center Junior High. And somehow, his words, not mine, somehow managed to graduate from Pittsburgh Sutherland High School. Along the way, he attended Camp Pioneer, Camp Eagle Ridge, and worked at the Pittsburgh Central Pharmacy and Camp Seneca Lake. His family, I like the way this came out, his family is true blue, or yellow, as we like to say, Rochester, multi-decade Kodak employees. University of Rochester grads, area high school teachers, and MCC and an MCC nursing professor. Though he began investing in 1968 with 2 shares of Ford, got to be worth a bunch today.
I sold them.
And then 10 shares of his best friend's company that turned out to be a fraud. Oops. He was a high school teacher and lawyer before devoting himself full-time to investment management. Tom graduated from Cornell University and the University of Chicago Law School, his words, when the dinosaurs roamed the earth. He and his co-author, a Syracuse native, credit upstate New York weather for making them skeptical, not blue sky investors. Today is a prime example of not blue sky investors. So, without any further ado, please let me turn this over to Tom Jacobs.
Those kids with Velcro instead of who ties their shoes.
What did you do to it?
I don't know. I'm like so hopeless. It's
Is it still attached to? No, it's.
I mean, how do you do this? I think. Can I just put it in my pocket?
No.
Oh.
We did this special just for you.
Oh, all right. Well, this really interferes with the flow.
How did you do this?
It just, that doesn't stick to anything.
Put it in your pocket, maybe?
Yeah, that's a good idea.
There
Yeah.
you go.
That's what normal people do.
Nice jacket.
Yeah, thanks. It is a nice thing, actually. All right.
Take 2!
It's a great pleasure to be here. And you're not supposed to say that the guy wrote his own introduction. It is a great pleasure to be here. I really have had fun with hometown audiences. I grew up on Gulf Avenue, just up the Marsh Road.
Right around the corner
From Powers. But I can tell you, and maybe a few of you, what Powers used to be like. I mean, it was run by tenant farmers, and they never had and they were tenant farmers, I'm telling you. I mean, there were people in and out from West Virginia, across the railroad tracks from us, and sometimes would go on the bus with us, sometimes not. But now it's this big, huge operation, and fancy Pittsford, and all this stuff, but really nice to have in town. I remember when we went to the dairy with our metal carrier with milk bottles, which my father later used to pick other things up at John Connor's liquor store. It was handy, right? Would you do me a favor, please? And this is play along, but nobody's going to be embarrassed. There's not going to be, no, my sisters wouldn't trust me, but you can. Okay. And the exception here is not Kodak stock, okay? And I'll explain why. Please stand if you currently own an individual stock. Stand up, please. Stand up. Not an index fund, not a mutual fund, but like you own Apple or you own something, okay? You don't own an individual stock. You do? Please up. Okay. None of you own an individual stock?
Yeah.
Please.
Yes, I do.
Right. No, please. This is not a trick. All right. Now, sit down if you did not own an individual stock 5 years ago. 10 years ago. 2000.
25 years ago.
1990. 1980. 1974. 1968. 1960. 1950. Okay, 1955. Okay. All right. 52. Okay. How many bear markets is that? Or serious bear markets since 1952?
13.
All right, you guys know a lot more than I do. All right, how about crashes? Since 1952, how many crashes? Don't count 87. 3, right? Can you name them? 73, 74, or 70, end of 72 to 74. 2000, 2002, and the most recent. So 52 to 73, 74, that was quite the time, wasn't it? It was quite the time. But how many of you remember the crash of 29? So we've had 3 major bear market crashes, and less than 25% of the room owned individual stocks in 73, 74. And people were already sitting down when we got to 2000. So one of the points that I would like to make today, not so much for this group, because this is an experienced, mature, wise, and studied group of people who aren't chasing Tesla. Darn Tesla. Only 10 times in, 18 months? How we feel about the stock market is a function of our own memories. My father was, by the way, when this is too loud, if I have it too close, just, tell me, yell out. I mean, I'm pretty informal about these things. I once was in a church in Wichita with an audience of about this size, and everyone was too polite to tell me that it echoed really badly. But during the break, they told me. All right, so my father and mother were Depression era. They were working then. My father went to Sergeant Greenleaf in the 30s, made locks and safes and so on. Perhaps some of you in movies you'll see a Sergeant Greenleaf, and then began to work for Kodak in the early 40s and was there until his retirement in 87. He was fortunate in that he had a job, and he told me all about, he said, elevators and secretaries were buying stock on margin. I mean, can you imagine? Elevator operators. Elevator operators and secretaries. So I grew up with this because you know how fathers basically have 10 lines and they say them over and over and over, and each time they think it's funnier than the last time? Right, yeah. And in fact, not just fathers, but basically all men. So I heard this secretaries and elevator operators over and over and over again. My mother had a different situation, which I will read to you, because of course I didn't bring the book up to the front of the room. Warren Buffett said, what we learn from history is that we don't learn from history. And this is going to be just a little piece, a little letter that my grandmother's broker wrote to her in 1929. So my grandmother had a 13-year-old daughter. I've already ruined this. You're supposed to ask me at the end, and I'm telling you it's my mother and so on. But it's been quite a night. You may have noticed I was 45 minutes late. It's been quite a night. So in 1929, my maternal grandmother was a widow in her 40s with a 13-year-old daughter. This is in chapter 6 of a book that you cannot live without. And this might indicate to you that I was what was used to be called a trailer child. One who comes quite late and quite unexpectedly trails after. Yes, to have parents and grandparents of that era. Or accidents, but I think we called it a trail child. So anyway, boy, if I don't stop doing the side stories, we're never going to get through this. So my grandfather died of pneumonia in the 20s, right? This is all before antibiotics and even sulfa, I think. Probably some doctors here could correct me on that. So she's trying to raise my mother. Husband died of pneumonia 6 years earlier, left my grandmother with a family drugstore. Unable to manage it herself, she sold out to her husband's partner. Who shot somebody? And invested the proceeds mostly in bonds. Because when did Americans first really start buying stocks? Individual stocks. And you know, for all everybody says, that's true to some degree, but it was still really a minority of people. It wasn't until the late 1940s and early 50s when we were enjoying the post-war situation where we had the only extant factories. I mean, not to blow anybody's bubble, but it wasn't that we were so great in the 50s, not that we weren't, but it was the only people with factories that weren't blown up, right? So we had this sort of golden era, and people really got into consumer brands. And studies show that what happened was people started thinking, well, I like my refrigerator, I'll buy who makes it. I like my car, my vacuum cleaner, that kind of thing. That happened in the 40s, but in the late 40s and early 50s. But in the 20s, you bought bonds. You wouldn't think of buying anything, I mean, other than the speculators, I mean, of course, who are in the market, and I'm not minimizing that. But you wouldn't think of not getting paid, right? All right. She cabled in July of 1929. July. Downtown, which was very elegant, right? To cable downtown to your Wall Street broker, and asked, well, I've been hearing these things, and things seem sort of jittery, and what should I do? Should I sell? So Schuyler, Earl and Company, members of the New York Stock Exchange, 6 Wall Street, New York, replies on July 25th, 1929. Dear Mrs. Candow, can't make this up, right? Candow? Answering your question whether to sell, it would be well to wait for a break in the market if one comes. How are you supposed to know that, right? But I must confess, I cannot see where a general break is coming from, and believe the stock market should not be considered as a whole, and that investing in stocks today is a matter of selection of companies and not a study of market conditions. Sincerely yours, I'm not making this up, Ralph Waldo Earl. So, if you have my sort of sense of humor, that's sort of surprising. Now, old Ralph had 2 things right. Individual stock selection and not market timing. What he didn't know was how to value companies, and he also didn't know how to protect the portfolio against the unknown future. Right? He performed what was probably what we call recency bias, which is the tendency that we all have to extrapolate recent conditions into the future. When you're buying a growth at a reasonable price stock, and you say, well, it'll grow at X, Y, Z, and you do a discounted cash flow analysis, and you think it's all lovely, right? But you're biased with what happened recently and generally project that into the future. Ralph did not value companies, clearly. And most investment advisors don't, right? They just buy what the research department tells them to do. Wells Fargo or Citigroup, and I know this firsthand because I deal with my partner's mother's accounts, which his brother, that was a lot of relations in there, wasn't it? Has with someone at Wells Fargo, so he sent to me all the different options you could have from Wells Fargo, and it's all gobbledygook. It means absolutely nothing And if you look at the model portfolios, there are 50 stocks, and of the 6 different things that, 40 stocks, and they're all distributed among all the different strategies. But it's all just marketing, right? So what I look out for, what Ralph should have been looking out for, what my grandmother wanted was managing risk. And the line about John and I growing up in upstate New York and not even knowing what the sun was. I mean, you grow up here, and I loved it, and I love coming back. But you know, you think where you grow up is the universe, right? Exactly. So we I mean, it's not why, but I like to tell that story. But my father raised me with the idea that something awful could happen at any time. Many of you have parents or grandparents who have that other shoe is going to drop any day mentality, right? And he was extremely cautious financially. Brought me up to be, and I still got taken in the internet bubble. So it's back to what we learn from history, we don't know from history. And it's one of the reasons I asked you all to stand up, because our own experience, very few people really invest and learn from investing except from their own experience. And I tell people who are looking for investment advisors, you know, of course I don't know if they would use me, but I tell them no, don't. There are a lot of smart young folks out there, but you don't have to be that smart to be good at investing. And when Buffett says all you need is arithmetic and to manage your behavior, he's not just throwing out a Buffettism. It really is about you're the person that you have to manage. I could go in some directions. It reminds me of the Canadian humorist Stephen Leacock, and he wrote about a knight in one of his funny stories. And the knight got on his horse and rode off in all directions. All right. So all this is to say that risk is what we're about, and now we may actually begin the program. What's behind the numbers? Takes the view, as I do as a value investor, value catalyst investor, that if I can control the ground, if I can control my losses, I keep my feet on the ground, the upside will take care of itself. Most people, of course, are looking at the skies and thinking that it's all going to be lovely forever, or are index investors, passive index investors, which with discipline, and though it has some problems, this is probably best for most people. Of course, I can't charge people a percentage of their asset management unless I'm doing my own research and offering something more than that. But that's not what I'm here about. I'm here about managing risk and how you can do it, and and seriously, you don't have to memorize the book, which is good. So let's move along. How manage Fleeces investors and how to catch them before your stock tanks. It has three parts. And this Mary Lynn made me promise that I would do the three parts that were on the agenda. I love teasing you because you're so fun. A different view of how stocks rise and fall. That will be part one. Part two, three ways management can prop up the stock price until it can't. We all are familiar with the phrase that things continue until they can't. Right? Things can be crazy a very long time, like the current bull market. Current bull market, insane. Could be another 10 years, who knows, right? We don't know when it will end. Ben Graham, Warren Buffett's teacher, I'm sure 90% of you are nodding. Nod, please. He said that all bull markets end badly. I mean, he didn't need much more analysis than that. And that's enough for him not to be a growth investor. Not that there's anything wrong with it. Three tools you can use to identify problems and know how to sell or avoid the stock. Firm feet firmly on the ground, avoid losers, and let the winners take care of themselves. Most people want their winners to take care of their losers. We look at it the other way. It's not original, of course, but it's a key element. All right, am I too far away? Yes. How the stock market really works. A different view, that's pretty provocative. Wonderful study, 1983 to 2007, longest bull market in the history of stock market records. Studied the Russell 3000. It was up 900% from 1983 to 2007. By the way, I have all these on handouts that you'll all get, so you don't have to take notes. Should we be distributing those? Does everyone have one? Yeah. How about we just take a second to, and here's the rule. As you dump a bunch on the table, you have to dump business cards. I am the world's worst at this, okay? People ask me for a card, I never have one. My father would roll over. I'll just continue with this and assume that I'm entertaining enough so you won't get distracted. All right, 900%, 1983 to 2007. But if you look at all the stocks in the Russell 3000, over that period, 39% were unprofitable investments. They did not produce absolute returns, less than zero. 64% underperformed the index. 64% were less than average. 19% declined by 75% or more. 75% added little to no return. Where are all the gains coming from? The gains are coming from 25% of the stocks. And yet, we all want to own the averages and passive index events? Wow, that sounds great. So the odds are strongly against you in picking stocks. Well, we all know that. We know it's a tough game because a lot of us really love this, so it almost is a game. I mean, I'm passionate about it. I'd do it whether I got paid or not. I just probably have to do it on the nights and weekends and have another job. The odds are strongly against you, and we don't know the future. My whole life is about calculating odds against an unknown future. Ralph Waldo Earl had no idea what was going to happen. But what should he have been telling a widow who had all her money in bonds? He should have been telling her that she should probably think about lightening up, given the situation with debt in the country, the fact that debt levels were ridiculously high, the leverage ratios of all the companies she had bonds in. We have the certificates, they're worthless. So, as Charlie Munger said, and the Greeks long before, show me where I'm going to die so I don't go there. This is the elevator of value, growth, and momentum, the only original thing I'll ever think of in my career. And it will also, the point of this, how the market works, is that mean reversion, or that over time, except in extreme events, things revert to the mean. You know, things. Valuations. Growth investors think that trees can grow to the sky and valuations can expand indefinitely. But eventually they will revert to the mean, whether through competition or simply market action. Companies do not maintain gazillion% profit margins indefinitely. Microsoft. Apple is done with its growth phase, pretty much. They're buying back shares, huge amounts, and paying dividends. You don't do that if you're a company that has something to invest in that you expect to earn a growth level return on invested capital. I'm not saying you won't make money on the stock. I'm saying it's no longer a growth stock, otherwise it wouldn't be paying dividends and buying back shares. Everything eventually reverts to the mean. If you're a value investor, you buy cheaply and wait for it to revert up. That's paying more attention to the downside risk. So here's how I look at it. Here we have, and I had to use this even though you have the cartoon stock thing and it's not very, because it really is great. Here's our friend, and he's at the elevator of value, growth, and momentum investing, and he wonders, where do I go? Up, down, all of the above, or none of the above? And this is maybe what some of your children beginning investing face, and I hope you're all educating your children on investing, as my dad did. He said, Tom, we'll take $100, which was a lot of money when I was 12 in '68, and we'll buy some stock. So what do you want? I said, well, we drove Fords and I chewed Wrigley's. So we bought Ford, like people who started investing in the stock market in the late 40s and 50s, right? I should have done Wrigley, but its PE was too high. It was too high, right? But I didn't understand about balance sheets, and I didn't understand about the intangible value of a brand. Coke has always been expensive, right? Coca-Cola has always been expensive, but there's a reason. And the same thing with Wrigley's. Anyway. So here's the value guy in the basement. A New Yorker cartoon. Back to the elevator, reading the newspaper. I'm not quite sure why the Christmas stocking is on the furnace, except I suppose that's supposed to be a fireplace. That took me about a year of doing this to figure out. But he's not paying attention, right? He's not excited. There's not a lot of ornamentation. Down is boring. Our guy doesn't want to go down because it's who cares? It's uninteresting. So it's an easy choice. Let's go up. And pretty soon everybody's pushing into the elevator, right? Everybody wants to go and do the same thing. A herd all wants to go in one direction. And there must be something exciting. So everybody packs into the elevator, it accelerates, and we hit the roof to profits, Skittles, and beer. Now, this may be considered retro of me to do, but if you'll notice, both genders are equally what we used to call scantily clad. So this is perfectly socially acceptable, in my view. So everybody's up partying on the roof. This is momentum, right? Growth is the elevator going up. Everybody's sort of piling in, and then now it's the last year of the market, in my view, but who knows how long it'll go, where IPOs are at a level not seen since 2000 and 1999, where debt levels are increasing and nobody seems to be talking about it. I'm not a perma-bear, and in fact, it always sounds more intelligent to be bearish, doesn't it? Yeah. It does. It's like, oh, well, yes, let's be cautious. I'm bullish when I think the conditions for the company and the valuation are right. But right now, it's just crazy if you look at valuations of companies and the number of IPOs. Okay, but the momentum goes, and now everybody's partying. Everybody wants to go to the roof. They all want to own Tesla and Zillow and Facebook and I mean, Facebook has $158 billion company? What odds do you take if you buy Facebook today? I'm not saying you won't make money, but what odds against an unknown future at 100+ times free cash flow, net cash from ops, earnings, whatever you want? What are your odds? Okay, I don't like those odds. Doesn't mean you won't make money. Someone at a company that I have a lot to do with says, Facebook will be the most valuable company on the planet in 5 years. What a ridiculous statement. How do you know that? I'm sure MySpace thought that it would be. And Facebook ate its lunch. I mean, Charlie Munger says anything sort of technological. Well, actually, I mean, Facebook doesn't count because it's social media, online media. But his view is that a company like Apple, let's say, which is a closed system, and all closed systems eventually die. Microsoft's a perfect example of all closed systems. They want you, and I'm a sucker for it. Everything I have is Apple. I can't escape. Geez, now I've really talked myself into a hole. Anybody know where I was? What was that?
We're on the road drinking beer.
All right, good, thanks. That's actually that was right here. Okay, momentum. So you buy it as the elevator is accelerating, and you buy at the top. I mean, there's nothing to go but down, right? I mean, the hangover, you can feel the hangover. All right, now, what is that? You have kids. I know you have kids. It's the glass elevator from Charlie and the Chocolate Factory, right?
Okay.
All right, trust me. So, party, up, but people don't stop at the roof. The momentum continues. The elevator of growth, value, and momentum, and growth goes off into the sky, breaks through the ceiling, and, of course, in the movie, at the last minute as it's crashing down, Johnny Depp, a.k.a. Thank you, Willy Wonka. There are jet jet sort of, what would we call them in science fiction? Yeah, well, they slow it down. It comes to a soft landing, okay? Your tape's not working, Julio.
Yeah, I saw that.
Right, I thought you'd need a little help there. So it can't stop dancing, going into outer space, and this was the only cartoon that my father watched with me, which tells us the story. We revert to the mean. Eventually, these crazy stocks will revert to the mean. Now, what everybody hopes they'll do is they'll get the one that doesn't, and that will make them all rich, you know, price line 50 times over X years. Right, wonderful. How many of us would have only bought that, or only bought a large amount of it, or not sold it? I mean, it's too risky for me. It doesn't mean that you shouldn't do it. So, eventually, mean reversion, right? So you see the process, everybody piles in, and particularly at the end of a bull market, individual investors are a contrary indicator, right? When individual investors and professionals, I have a slide on that, but we'd never get through it if I had put every slide in. When hedge funds and individual investors are both highly bullish, and it gets higher and higher and higher. There's actually a great AAII study on this. Bad news ahead. So, of course, it blows up. It all ends badly. Ben Graham, it all ends badly. So, how boring does the basement look now? All right, fine. That's something you really need me to tell you. You really need to buy a book for. It's great learning. Let's take Coach. So a year ago November, I'm speaking in Dallas-Fort Worth to a better investing group. I really like AA and better investing. Wonderful audiences, bright, thoughtful, not a bunch of people sort of looking down their nose at how much they, and how much they know, but it's more of a community feel. It was a great time. So I'm talking with them, and beforehand, one of the stocks that is very popular in BI a year ago was Coach. So I decided to use it as an example. Now, I apologize for the small print. He said getting new glasses about every 2 years. Familiar? This is Coach from 2001 to last November, 2013. Coach was a major growth stock, right? 20 times in 7 years. Then 30 times in 11-ish, right? A lot of growth, and then the broad market has the effect on Coach as anything else, a lot of growth. Okay. At some point, it gets to be a momentum stock. The valuation were 30, 40, 50 times for a consumer goods company. I don't care how many Coach purses somebody wants to buy a year or every season. We're a luxury goods maker that's not Tiffany. Well, a bad example, but it's not an enduring 100-year brand yet at any of these times. So it's a market darling. Okay, then we start seeing 2009 and which is the market? That would be the green, and Coach would be the blue. So you start seeing on a percentage gain basis that it exceeds the S&P 500 dramatically, right? But then the gap starts to close. Growth investors are starting to not see the level of gains. And as soon as that happens, growth investors want growth. So now, that was a 5-year chart. This was a 14-year chart. 5 years, we start seeing reversion to the mean. The market averages the mean. 2 years, we really see the growth investors gone. The momentum investors have already started to leave, as you could see, and the growth investors are leaving in droves. Now, that's fine, Tom, you make this observation. It's sort of like anybody can look in the past when I gave this presentation. But then we look at 1 year to that, and we dramatically see growth and momentum investors gone. Buyers bought for growth, buyers bought for stock momentum, momentum buyers sold, growth slowing, growth investors selling. The elevator goes through the roof, crashing down. Who wants the stock? And in this view of the market, the stock, and of course it's backed by earnings and cash flow growth rates that are declining, will at some point be a value and it will be bought again, but I made the case a year ago that Coach was pretty much done for. You weren't going to make a lot of money on Coach. I mean, I suppose if they got a Carl Icahn in to turn the board around and get a new CEO, who knows? I'm not big into retail because I think it's a really dangerous place to be. And then this is what's happened in the last year. Coach has dropped another 30%, while the S&P is up 17%, relative return of negative 47 points, if I have that right. It's one of the rare times I've been able to look back and say that things sort of worked out as I might have suggested the probabilities are. I have plenty that didn't, but I'm going to show you this one. But actually, I'm showing you this one because I already have the Coach slides, and it gives a great example. So, all right. So that sets the stage for that management wants to prop up the stock price. They want to fight that game, even though that's how the market works. Why do they want to keep the stock price up? Because stock options are worth a lot of money. That's how people get paid the big bucks today. They don't get big salaries. Well, I'm not saying they're not big salaries, but the big mega venture capital style payoff, if you're an executive, is the stock option. So you have to keep the stock price up. And of course, you want to keep your job so you can keep getting great options and so on. And I'm not being, I invest in companies, right, that have CEOs. I just have learned that an awful lot of them are about enriching the CEOs, and it looks like the stock price is good for us. But the problem is, all the games to keep the stock price up, that elevator is just not going to go up indefinitely. So the games push and push and push and push until you have nowhere to go but down. So the three I'm going to pick out, in the book we do a billion. John is, let's just say turning him into English was my job. The aggressive revenue recognition, cash flow warnings, and serial acquisitions. These are three of the biggest red flags that tell you that your company is headed for a blow-up. Management knows that Wall Street wants rising revenues and rising earnings per share. This is no news to anyone. So they play to Wall Street. Management will do everything it can to manipulate. You know, this beat by a penny and miss by a penny? It's hilarious because I used to just laugh, and sell-side analysts mean absolutely nothing to me whatsoever. But now that I'm more on the forensic accounting part of things and understand it better, when they miss by a penny, let me tell you, they went into every seat cushion on that couch looking for that penny from some cookie jar and didn't find it because it isn't good to miss by a penny, right? I mean, if you're going to miss, you might as well miss by 5 cents, 10 cents, whatever, get out of the way. And boy, if they beat by a penny, they were not only in the couch, but they were my mother, who knew from my very young age that she could always go in and scrounge around on my floor in my bedroom for change because I was undoubtedly the messiest and least organized person on the planet. So if she needed a penny, she would find it. Well, it was usually nickels and dimes in those days. Quarters. How many of you lean over for a penny now? Inflation is really, all right, well, I should learn. I pretty much, a dime is where I start. Quarters, definitely. Well, you know, some people are rational and sensible. So, they don't want this because it's these missing by a penny, beating by a penny things at the quarterly earnings reports that really determine the elevator. And once the growth is over, I mean, you get hammered a couple of quarters, growth investors aren't interested in you anymore. Value, of course, as you may imagine, is what I practice, and it's because I don't have to really care about any of that. Can't get any worse on a valuation level. So, relying on EPS and revenues is fraught with danger. Aggressive revenue recognition, stuffing the channel. This is where it's the end of the quarter, the CEO gets on a plane, usually a software company, and goes to the biggest client and says, Ms. or Mr. Moneybags, if you sign up for another year of Salesforce.com, I didn't say any company called Salesforce, and we will give you, if you do it now before the end of the quarter, we will give you 10% off. Now, you know they're going to renew, right? They always do. But you've got to pull some money into this quarter to meet your numbers, to meet the estimates, or else you'll be on the wrong way on the elevator. So, what's the problem with that? It's the loan shark, right? You borrow at 8%, and then you can't pay that. So you go to the other loan shark and you buy for 10% to pay for the 8%, and then you borrow at 12% to pay the 10%. Doesn't work. This is exactly the same thing. The company is simply pulling future revenues that's going to get anyway forward, so it has to make those up, or eventually the game is up. Now, you may think this is very simple-minded, but let me tell you, it goes on all the time. Absolutely all the time, and not just in software companies. But sooner or later, you can't keep it up, and you are going to have to face the music that, oh gosh, our revenues are not growing 30% year over year anymore. Boom, you're done if you're one of these stocks that people are only buying for increasing revenues. They're off the train faster than some cliche I can't think of. So, it works until it doesn't. And how do you know? Days sales outstanding. Right. This is how many days it takes a company after it recognizes revenues to be paid. So if its accounts receivable are expanding faster than revenues, not good, right? Because perhaps the customers aren't paying. Perhaps the customers are having lower quality. They're lower quality customers. Perhaps there's stuffing the channel. Let's bring in this new revenue so it shows up as higher revenue, but guess what? It's not being collected. And this is an indication that the company may be extending favorable payment terms. I mean, why give somebody 10% off if they're going to pay full price anyway next quarter? Plus, by the way, they get used to this, and then they expect it every year. Okay? So, the only way to really tell what's going on is DSOs, days sales outstanding, which you can find through various online sources, or you just do revenues over accounts receivable for a number of quarters, which I'm sure all of you do in your spare time. Decker's shoe company, and I don't even know all the brands they make. Again, I'm not big on retail. All the time, earnings and revenues are rising. This is 11 and 12, right? Rising. DSOs are expanding. Days sales outstanding are expanding faster. They are growing. So they're going year over year from, let's just say, 50 to 52 to 54, something like that. And there is no greater red flag that says the elevator is going to drop than increasing DSOs. It's no guarantee, but it is a very reliable predictor of poor stock performance ahead. And we're trying to avoid the blow-ups, right? That's what we want. We just as soon weed the garden and let everything else grow. Yeah, that was a powerful metaphor, okay. Around here, John starts seeing the year-over-year DSOs go up. Shorts around here and covers around here. Now, I'm not advising shorting. I think it's a very difficult game to play. I just think it's a good thing to know to avoid stocks with increasing DSOs. One example. There are so many more in a certain book. Cash flow warnings. Cash flow warnings are when the person in the house who takes care of the money says you have to stop spending because no, that's not it actually. All right, cash flow warnings is it looks like cash, but it really isn't cash. Now, some of you may remember in the early 2000s, there was this big debate. Are stock options an expense or not? Remember? And Warren Buffett was saying, if they are not compensation, what are they? And compensation is an expense, or what is it? I'm not getting his words exactly right, but we won that battle. Companies were required to expense stock option grants, the value, some way of valuing them on the income statement. So they reduced earnings. However, sneaky, because this isn't a cash expense at the time that they're granted, that the management team gets the options, not actually giving cash away necessarily, you add it back on the cash flow statement. Because it's not actually cash that's gone out. And the cash flow statement is our friend because it really tells us where the cash is. Well, sooner or later, you're going to have to pay for that, aren't you? You and I, if we are shareholders in the company, and those options get exercised, we're certainly going to pay because we'll have our ownership diluted, right? So sooner or later, that's money. Currently, Salesforce, my bête noire, gets 50 to 75% of its operating cash flow on the cash flow statement from adding back stock-based comp. What is it doing? It's just putting off and putting off and putting off. What will happen and is happening is that people cash in their options, the dilution continues, and eventually the rate of stock-based comp will decrease. And then, where is the cash flow? What does Warren Buffett say? You can always tell who's swimming naked when the tide goes out. I like that one. And eventually, that cash that you're adding back, and it looks like you have, and you're spending it on CapEx, and also $250 million Salesforce on a campus in San Francisco area that they then promptly never used, and then rented space in the city. Now, do I sound like someone who was short the stock at one point and has been continually disappointed? Yes, I'm absolutely someone like that. But Mark Benioff, that game is going to go on until it can't go on anymore. And the company is too big, really, for Oracle to buy it. They're all saying, you know, Oracle needs to be more in the cloud and so on. All right. Rambus, an intellectual property company that was a hot stock in the early 2000s, there's no reason any of you should know it, believe me, and best to forget it, was 100% of their cash flow from operations came from adding back stock options for years. Their business was selling intellectual property, basically getting a royalty on memory design at the time. So you think you own Rambus, and you think you own this great income stream on intellectual property, right? On patents, you think you're going to get this great licensing income, and isn't everything great? And actually what you own is a company that's making money by granting stock options. Well, that has to end. At some point, it's unsustainable. And because companies typically what they will do is if the stock does it, the tech companies do this. If you don't, because they're all competing for the same people, that's another reason I just steer clear. I can understand that you have to offer people the opportunity for Las Vegas type returns if every software developer has 10 offers. That's just not an investing area in which I want to play, and particularly not with client money. All right. So sooner or later, Salesforce, you heard it here. Darn it, dagnabbit. Sooner or later, Salesforce can't keep it up. All right. The growth up. Serial acquisitions, simple one. Companies that are constantly adding new businesses. Now, there are CEOs who can add businesses and increase returns on capital. Why is it I can never remember his name, even though I own the spin-off? National Oilwell Varco. services company, and they've just spun off DNow, or Now Inc., Distribution Now, which is very, very interesting. The spinoff is really interesting because Pete Miller, that's it, the guy who built National Oil Well Varco, which I always want to say Velcro, don't you? This is very hard. Pete Miller left National Oil Well Varco and went to the spinoff. Yeah, it's really difficult. And when the CEO does that, you sort of look up, you take notice when the parent's chairman and CEO goes to the spinoff. Actually, he's chairman at the spinoff. They have a CEO that he worked with for years. National Oil Well Varco was a roll-up. He added companies, and kept adding value. He's one of the few CEOs who has been successful at this. Usually it's just a mirage to keep everybody happy that you're doing something. Very few people can manage acquisitions well, pay the right price, integrate them. Most of them are like Hewlett-Packard, which buy company after company after company so that you can't really tell how it compares with the year before. And it's my most hated cliche, and there are so many. Curated, artisanal, and handcrafted. Don't tell me anything's curated, artisanal, or handcrafted. I'm a curmudgeon. But apples to apples and apples to oranges. I haven't come up with a better way of saying that, though. If you can, let me know. But it is a terrible cliche. But when you are always acquiring companies, what's your baseline? There's never any baseline for you to really gauge. And so Hewlett-Packard hasn't really hidden it very well. But they just keep wasting money on acquisitions that don't produce increasing returns on capital. And they get away with it. And then they keep increasing their debt and buying back shares and paying dividends. And sooner or later, and it's not that the stock's done that well, but the day of reckoning is coming. Maybe they'll do some spin-offs and spin back out companies they bought at about 1/10 of what they paid. Cisco Systems, perfect example of a company that's done that. We have absolutely no idea. And when the write-offs come, oh baby, look out below. Serial acquisitions. So aggressive, for accounts receivable growing faster than revenues, cash flow that is a lot of stock option comp, stock-based compensation added back in, and companies that are serial acquirers. And there are a whole bunch of other things. But what John and I do, or we hope we did, there are about 3 or 4 books in this field, right? And we thought, well, why do we need to write another one? Well, we thought we would concentrate on the big ideas. That is, the best predictors. Not Mulford and Comiskey have written this incredible college text, graduate school text on the field. And that's wonderful. But the practical investor wants to know, what's the worst? DSOs, days sales outstanding, cash flow warnings, and serial acquisitions are 3 of the top 5. Inventory management too, but that's a more complex subject for what you thought would be brief, but is increasingly not. All right, tools you can use. Tom, I'm really not going to do these things. I'm not an accountant. I do enjoy it, and I like it, and in fact, I may even buy the book. Right? Or even the ebook. Or, if you're really brave, the audiobook. We couldn't get James Earl Jones to do the What's Behind the Numbers audiobook. So I did it myself. You can judge whether that's something you want to have in the car or not. Forensic Accounting ETF, or FLAG. That was a nice ticker to get. That was after Flagstar Bank went belly up. It became available. Forensic Accounting ETF applies all the principles in the book that we've been talking about. And it does it in this way. It takes the 1,000 largest stocks by market capitalization. It takes a number of earnings quality indicators, puts them through are you ready? Proprietary database. Boy, we've never heard of proprietary method before, have we? If it isn't proprietary, it wouldn't be exciting. It's sort of like everything's premium now, and that gold isn't good enough. We have to have titanium and sapphire levels. All right. But to be serious, it is actually proprietary. Otherwise, we wouldn't have had anything to put in the book. We take the 1,000 largest stocks by market capitalization and we rank them. We put their numbers through the ringer and rank them according to scale from A+ to F. These are the 6 categories: revenue, cash flow, earnings quality. Well, revenues and cash flow are earnings quality, but earnings quality is sort of a catch-all for a bunch of the other important but less dominant earnings quality red flags. Expectations, we do put in a little bit for what analyst expectations are versus how we see the other parts performing, because it's the missing and beating by a penny, particularly missing, that lead the stock to collapse. Valuation, I managed to get something in there on that. And shareholder yield, which is basically, is management paying you to own the stock, whether there's a dividend, whether there are buybacks, whether there is a declining share count if there are buybacks. So we take all the stocks and we rank them from A+ to F. Let's just look at 2. 3D Systems is currently 999 of 1,000. If you've seen the Calkins Road School in Pittsburgh, the Calkins Road Junior High, let me tell you, that looks like a college campus to me. I went to Menden Center. Look at Menden Center and look at Calkins Road. I got a darn good education and I didn't need that building, but it is really amazing to see. And there was a point about that. Oh yes, all the kids who take the tech class or something in junior high get a 3D printer. That's what 3D Systems does, by the way. I may be assuming too much. I'm like, cool. The problem is, 3D Systems, great, speculate on it, just not with all your money, right? If you must do something mad, do money you can afford, do it with money you can afford to lose. Surging DSOs. The channel refill overstates organic growth. Cash flow trends are deteriorating. Expectations and valuation is stretched. And this was 999 a year ago. And if you look at the stock chart on 3D Systems, it was a pretty good predictor. But we're not trying to predict the market. What we're trying to do is talk about probabilities of blow-ups. Flag is, well, as I'll explain, it's not about predicting. It's about trying to get to that 25%. Remember at the beginning? 25% of the stocks responsible for most of the gains and avoid the 75%. So yes, it eventually did come around. Risk of owning 3D Systems is high. In our calculations, taking their financials, it scores F on revenue indicators. That would be the DSOs rising. F on cash flow, as in there isn't any. D- on earnings quality, expectations F, valuation F, shareholder yield F. If you didn't get the idea. What we do then is we take all the average grades across the 6 factors and then the top 50, okay, the math's going to be rough because one of these is 750 companies and the other is 1,000. So let's do the 750. The top 50 become A+, the next 50 A, next 50 A-, and all the way down. And John's stepfather, who was doing a lot of the IT work for us on this, had F+, F, and F-, and I had to explain as a 7-year high school teacher way back in the day that if it's F, it's F. So the bottom 150 are F. And of course, he's great, right? He was a retired consultant, but works harder now with us, I think, than before, and from Syracuse. And he just said, oh, Tom, I know. What was I thinking? Now, let's take a local company. Though it was, I was here growing up when the headquarters people went to Stanford, but the plant's still out there, right? In Webster? Yeah, of course. I mean, just checking. So the DSOs are great. they're all, I mean, I don't want to get into every indicator about Xerox because it's the kind of company where you say, well, Tom, they're not growing. I couldn't care less. They're buying back shares at a discount to value. I would rather have them do that than waste it on acquisitions like Hewlett-Packard. And why is it that all the good turnarounds are at companies that have women as CEOs? Actually, that's not entirely true at every company. But at Xerox, I believe that there is a woman at the helm. In fact, I know that for a fact. And capital is being allocated for shareholder benefit. There are a number of other factors that I'll show you in a minute, but the risk is low. It's not that you should go out and buy it, it's that if you own it, the risk of blow up is low. So one, I'm actually looking at it pretty closely because I really like buybacks at discounts to what I believe to be fair value. Revenue A+, cash flow B-, earnings quality B+, B- for expectations, A+ for valuation, shareholder yield A-. Again, the buybacks are massive. So, great work, gold star. I didn't realize till after though that it was in red. It's like, but it's really hard when you go to Google Images to find exactly what you want. All right, we're coming to a close, folks. So take a deep breath. You've had a long week. Some of you worked today. Wonderful of you to come. Now there's just one more thing you have to listen to. Now, great. So you could buy Flag. You can go out and buy it. It's an ETF, exchange traded fund. You enter Flag in. Oh, perhaps I should finish with what that's about. So what Flag does is it takes the A stocks, the B stocks, the C stocks, the D stocks, and the F stocks. When you average them all together, drops the F, does a little weighting of the D, more weighting of the C, more and more of the B, and the most weighting of the A. And you might say, Tom, why weight D, C, or B at all? Well, backtesting through attribution analysis, which John says he knows what attribution analysis is. I have no clue. I don't know statistics. I have no idea whatsoever. That sometimes the D and the C and the B stocks over time outperform their ratings. So we cut the 20% that are F, have a little bit of the D, a little bit more of the C, a lot of the B, and then the vast majority weighted with the A's. And the results going back like 10 years are pretty fantastic. No guarantee of future results. All right. So, Flag has been around for about a year. And you can see it. You can put it in your Google Finance, your Yahoo Finance, and there it is. This is my baby. This is the what's behind the numbers stock grader. And if you've ever worked with app developers, you know what I've been through. Oh, we'll have this done and out in 2 months. It was just submitted to Apple for the App Store last Friday. So that would make it 4.5 months. What's behind the numbers stock grader is an app for your iPhone and then a month later for your Android device. And it takes all of what I told you about Flag. It does it only for the 750 top stocks, which was completely arbitrary and had something to do with the software. And not a bad thing, I'm not saying it was a glitch or anything. I'm sorry about the fuzziness on this. This will load the top 750 stocks by market cap, right? You log in, you see this, you can organize them by ticker, company name, market cap, and price. And then we all know now that to friend is a verb, right? From Facebook. Well, to favorite is now a verb for what's behind the numbers stock grader, TN. So you favorite these, and you can get, because you can have 25, 50, or 100, and then see how they score according to the criteria that I've been giving you. Now you might say, Tom, well, why not just put in the whole 750? Well, what then happens is somebody just gets your app and takes all your results every month and sells it to somebody else. and all the work that John has put into this over 15 years would then be useless. So, all right, fine. You pick a favorite. You can delete them, you can add them, and every month we update the results. We run the scan once a month and a lot of companies, of course, are reporting earnings and their numbers change. Here's what you see. You get, the company has to be one of the top 750. See its ticker, you get the current month rank, the overall grade, remember the overall grade on the right side? You'll get that, and that's every 50 stocks, A plus, A minus, right? Change in rank from the prior month. So this is number 3 this month. It was 25 last month. And then the 6 multi-factors graded individually. Green and gets a little lighter, and oh, this is so fancy. I had to really work to get that. Now, okay, so a wonderful little app that we hope will work. If you get this on your Apple device and buy a month, because they won't let us do it by subscription, and since we update it once a month, you know, you pay every month for it. It's, we wanted to have a subscription, of course, because then it's like a gym membership and people just sort of forget about it and the money piles up. But that's pretty unethical, right? We all hate stuff like that. So when we found out we couldn't do that, we felt, well, good, now we're forced to be ethical. So there was a point there somewhere. Oh, yes, if you pay the $2.99 or $5.99 or $9.99, depending how many stocks you want to favorite, and you email me with your iTunes receipt or whatever, we will gladly pay your first month. All right? Because we're actually looking for people to be early adopters and test it and see what the problems are, because as we all know from our apps, there will be 9,000 updates addressing everything, future. And it's best if you have a PayPal account, because I'm really not going to write you a check for $2.99. But seriously, on any of the email addresses on the card, if you get one of these, just email me your receipt with enough, with your PayPal account. And I will personally refund your month. I'm going to regret this. And if you forget or don't know what I'm talking about or want to ask me questions, you just email me. All right, here are the Breakfast Club stocks from July, rated according to this month's What's Behind the Numbers stock grader. Now, first of all, you'll notice there are a lot of NAs. That's because they're not one of the 750 largest cap stocks. Now, of course, I'm glad to see that, because as a believer in Fama and French research and small cap value, good to see that, though most of them seem to be rank speculations in biotech. Not that there's anything wrong with that. So here you have the number overall. So for Skyworks, this month on What's Behind the Numbers stock grader, it's 526 out of 750, and its overall rank is D. Now, some of these are speculations. You expect them to be low, right? Okay. Eris Group, 198, B+. Tractor Supply, very odd. I don't understand this, because Tractor Supply is very shareholder friendly, but maybe it's based on, maybe its valuation is crazy or something. Allergan, that's very interesting, because they're trying to buy Valiant. No, Valiant's trying to buy Allergan, right. Micron, 260, B-, Gilead. This may be valuation, but when would something like this, something like our 6 criteria, really be not helpful? Oil and gas, because it's based on stuff in the ground that isn't measured on the balance sheet, cash flow statement, or income statement. Biotech, because we don't know what's in the drug pipeline. It doesn't show up in the financials. So I think for certain kinds of companies, you have to be very wary. And remember, this is not a predictive device for investing and making money. We would like people to use it as a check to see, well, what do I need to look at? I own Future Fuel. Well, no, that's a bad example because it's not on the list. I own Tractor Supply. Well, on 6 earnings quality factors, it gets an F. I should maybe look at this a little more closely. And then you may be satisfied that there are things that this is not picking up. Gilead, for example, I gave a biotech years ago. I used to, back in the day, write the monthly investing column for Nature Biotechnology magazine, and I finally realized this is just ridiculous. I'm just going to lose money. I was back in the boom. Okay, Celgene, F, Mallinckrodt. Now, Mallinckrodt's interesting because it's a spin-off, and that's an area where I really like to play. We passed on that for a number of reasons, but it doesn't mean, we think we have better ones, but it doesn't mean there's anything wrong with it. I was kind of surprised to see that. Visa D+, I bet that's valuation. I bet that's highly based on valuation. So energy, drugs, and financials aren't necessarily the best for pretty much all screening of any kind. Cognex, I can tell about that. I don't know what these people do, and then these are all smaller. Okay, so this is mostly useful for people who are buying the 750 largest stocks. This is how to get a hold of me, and you can text with your name and email to find out when the stock grader is officially in the store, get my quarterly letter, no spam will call, you can email, you can do whatever you want to be my best buddy. So, I can't remember number 1. What was number 1? 2 was 3 examples. Oh, first was how to think about the stock market, particularly if you're a growth investor. You need to know this stuff. Growth investing is very dangerous. Over time, research shows that actually value and momentum are the best performing. That growth over time is a loser. And they're all, I don't know why, but David Swenson, the Yale endowment manager, has all these stats on it, and other academic research. Obviously, it's a matter of picking individual stocks. The problem with momentum is it's a great theory. Piling onto the elevator is a great idea. Galloping with the herd makes sense. The problem is nobody knows when it's over. And if you miss when it's over, you're toast. Okay? People who bought Netflix at 400 before it dropped to 50, they anchor, right, to their buy price and they're happy now. But that's not the way we want to invest. Right? If they were buying on momentum and missed the boat, I mean, you don't know it's the top and you don't know it's the bottom, right? You have to buy based on sound principles, buy and sell based on valuation and sound principles. This is simply a tool to add to your toolkit, and I show them because they're ways that we can put these things to use in our own lives without having to be forensic accountants. Thank you very much. Go Sutherland and Mendon and other Pittsford teams. And I would love to take some questions at this time. But first you have to clap for the video. Man, tough crowd. Sir.
Have you ever thought about setting up a mutual fund with these principles in mind? Take a lot of the work out of it for me.
Well, no, but that's what FLAG is. Today, here's the thing. The mutual fund industry is on the way out because ETFs are taking over. People don't want to just buy at the end of the day, get the end of the day net asset value. And so we have a lot of index ETFs, right? But what we don't have are more active ones, and those are starting to come. Those will imitate the actively managed mutual funds. But FLAG is actually an index. It is supposed to, it's the idea is that it's an index, the S&P minus, or well, we can't say the S&P, 750 largest stocks minus the losers. It is actually an index on the New York Stock Exchange. They calculate it. And then FLAG, we obviously produce the data, but there is actually an index out there. And you can't buy it, but you buy it through FLAG. So you could do that. You just go to your discount broker online, type in FLAG, buy some shares.
That's the ETF number.
That's a ticker. Yeah, they trade like stocks. Yeah. Leo, the way to think about it is that this ETF and all ETFs all they are mutual funds. But I'm sorry, I'm just repeating for other people. I mean, that was hard for me to learn. That you buy and sell like stocks. All right. Yeah. So flag and buy flag. No, I can't say that, and it's not for everyone. I'm simply trying to explain what it is. Our view is it's a better way to invest if you're an index investor. Whether past performance is no guarantee of future results, but this is what's behind it. And this is how to understand it, because nobody looking at it online will understand what it is. And it gives us a way also to offer people something from the book without having to become a forensic accountant, which I know that's what you want to do for the next 20 years. Sir?
Why do the real estate stocks down when the other stocks are up?
And you are Arnie. And Arnie's asking, do you mean like REITs?
Yeah.
Or you have an example in mind? Or
Well, ARCP and
American Realty Capital?
prices are down and the other stocks are going up high. And yet they pay a good dividend.
I think other than the big stock, first of all, I have no clue. But that said, I'll venture an opinion, right? Because I don't study that particular company. I do own a couple of REITs that I think are truly excellent. But when you want to get a REIT is when it's relatively new or it's being turned around and it's in the phase when it's selling the shares to raise capital to reinvest, when it's raising the debt, getting up to that 50% debt leverage ratio, that's when you want to own REITs. Once they hit that, it becomes very hard to deliver returns. Why are they down? I have no idea. Mine aren't. Now, they're not down, but they're sure not doing what the market's doing. In terms of my value with catalyst approach, I got killed the last 5 years. Well, killed. Made money, of course. But meanwhile, the go-go growth stocks are making us look like idiots. Value managers have had a very, very tough 5 years. But I guarantee you, I can't guarantee you what I will do, but it will end. How did people feel in 1999? They felt great. I was so smart, Cisco baby. And this is investing since 1968, and still there. But how many years of returns got wiped out in 2000, 2002? At least 10. Oh, more probably, but then in 2008 and 9, it was 10 years, right? So it's really important to be able to not go with the herd and to suck it up and say, my process, whatever my process is, I'm going to stick with it. When value investors start buying growth at a reasonable price, that's when you worry. Because they're starting to lose money from their investment funds, and the clients are demanding more. Why aren't you going to the moon like these other things? And finally they give up and buy some growth. Boy, is that a contrary indicator. I've seen that happen in 3 markets. But you've got to suck it up. You've got to be able to take it. While everyone around you is popular, you have to be willing to be the odd man out or woman out. Paul.
Does any of this relevant to master limited partnerships? Could we utilize it somehow?
I have a policy. And my policy is, if it's too hard, it's too hard. And I just, do I wish when Kinder or Morgan, one of them, left Exxon in a huff before, Enron in a huff, long before Enron blew up, and I just invested everything in Kinder, in this guy and every one of his companies and the MLPs and so on. Sure, but I don't really understand MLPs. And I do sort of. What I really like are REITs that are infrastructure related, like Core Energy, CORR, ultra small cap. This is not a recommendation. Write it down at your own peril. I have clients invested in this, and I invest all my money the same as clients, right? I mean, otherwise you have no business being in business, I think. You have to eat your own cooking. I also don't believe in having any clients in mutual funds or indexes because, or, you know, like the broad averages, because you can do that yourself. You don't need to pay me a percent or whatever of assets a year or pay somebody else to do that. That's fraud. Ooh. Gosh, yeah, that's not fraud. And by the way, there are IAs in the audience probably who I am not, this is not a personal attack. I don't mean that. I just think that clients, almost any client can index invest and own mutual funds and not need to pay someone to do that. Now, but back to the question. So Core Energy is an infrastructure REIT. So you're getting the cash flows, but you're also getting more growth. The thing about MLPs is you're not really buying them for the growth, in theory, right? I mean, you're really buying them for the cash. And when you get the combination of an infrastructure REIT, what Core Energy does is it buys pipelines and other not just pipelines though, like port facilities and so on, and builds up the leverage, builds up the dividend, and grows. And if you capture like a 5 or 10 year period of growth, though I expect this one to be much more, I have no idea, I've been wrong before. But MLPs are just not my thing. I could have said just no, but it's a good question. I get asked every single time for the last 2 years about MLPs. Why? Because they're really, really interesting. And they can be, and particularly in negative real interest rate environments, they're very attractive. They're just too complicated for me, that's all. Jack.
I have two questions, Tom, regarding what do you think is the best measure market valuation, percentage gain each year over time? What's the average of the best indicator out there?
Okay, you're saying,
Yeah, like S&P 500.
so what does the stock market on average return per year?
I'm talking even before, prior, and going way back, even before the Great Depression.
Well, people throw out a lot of figures, right? And I think that it doesn't, can I be honest?
Sure.
It doesn't interest me that much because the numbers aren't inflation adjusted. Now, I'm sure some of them are, but Jeremy Siegel in Stocks for the Long Run, which is a very misleading book and has influenced an awful lot of people to think that if you have 200 years, the stock market does nothing but go up. I don't have 200 years, do you? Now, they throw around 8% a year, right? But it's, most of us probably have 20 years, 20 really thick earning years of investing in stocks. And maybe a little more now that we're all living a little longer, as this gentleman says, yes, a lot longer. But seriously, I mean, back in the day, people didn't start thinking about saving for retirement until they were at least 40, because there were all these other expenses in life. And with the discount broker thing, it's become, much easier. Anyway, back to your question. So they throw around 8% annualized, right? All we care about is annualized returns. For all rolling periods. Well, no. The other thing Siegel says is that there's never been a negative 20-year rolling period, but that's not inflation adjusted. Why do we invest in stocks? Not to get rich, to beat inflation. This was also what happened in the late 40s and early 50s, was that there became an awareness that there was inflation. I mean, you know the old saw, right? What's a dollar from the year the Fed was founded worth now? 2 cents. Actually, that was probably 10 years ago, it was 2 cents. Because I've been saying it for about 10 years. So that's the answer. I mean, the market averages I think are very misleading because for the S&P 500, the best days of growth are over, right?
Yeah, so what's the correlated PE then?
For the market?
Yeah.
What's a high or low PE?
Yeah, what's the correlated PE based on? Let's say you're going to just index yourself to achieve that 8%. So what's the correlated?
Well, if you're going to index, you put it on autopilot and you put it in every 2 weeks, right?
Yeah, but how does the PE correlate to that index?
So you're talking about, let's say, the S&P 500 operating earnings
Yeah.
PE.
Beyond it.
I'm a fan, and for some of you will sneer, and perhaps rightly so. I tend to be a fan of the Shiller Cape, cyclically adjusted PE. And people like to say, well, but that doesn't really, Shiller's Cape, you can find this on his website. Robert Shiller, Irrational Exuberance, the housing boom guy, wonderful. Pardon me? Nobel. Oh, yeah, Nobel. The same year that Richard Fama got it for efficient market theory. That's like believing in the tooth fairy. But the interesting thing about efficient market theory is that Fama repudiated it and came up with small cap, low price to book as a true academic, willing to question his own work and throw out his own work. Who does that? All those Chicago economists, and I went to the University of Chicago, Lucas and all these people write these ad hominem letters to The Economist defending dead theories, pretending behavioral finance doesn't exist. We all behave like rational people. Tell me if you found a $100 bill on the thing, you just go and put it in the bank. No, you go out for dinner, right? We're not rational people. And so Fama gets the Nobel with Schiller and, not Akerlof, he got it before. I forget who. And they split the $1 million or $2 million, whatever it is now. And it's for something he's repudiated. But it was a big deal, right? People still believe in the efficient market theory fairy. I don't know if that answered your question. I like the Shiller Cape, the Shiller cyclically adjusted PE, because it's internally consistent, and I think that a lot of the arguments against it don't make sense. I don't rely on any one metric, and I certainly don't care if the market's overvalued, though I do hedge portfolios, right? So I have to have some macro view if I'm hedging, right? So I can't be completely...
I mean, there's a long-term mean PE.
Right, and he would say 16-ish, right? And he would say we're at 25, 26, but remember it was in the 40s in 99 and 2000. So markets can go on a long time. If you've got to go, but make sure you buy a book first. Who else? Paul. Oh, I'm sorry, you're next, sir, okay? Yeah?
I was just going to say, when you hedge, what do you hedge with?
This is not a recommendation, but what I do is I have HDGE, which is John's very specific shorting ETF, which of course has done horribly because the market's gone straight up. And I use it as 10%. I start with 5. As it drops, I bring it back up and bring it back up and eventually to 10 as a top. And then as the market drops and it goes higher, I bring it back to 10 and then to 5. It's not entirely scientific, but that's HDGE, hedge. But you gotta be really careful with it. I mean, you're not going to lose not going to lose all your capital or anything like that. It's just you have to be prepared for long periods where it underperforms because the market's rising, right? Cash, of course, is a great hedge. I mean, Seth Klarman, brilliant investor, MBA from Harvard, his professor gave him $25 million to manage when he graduated because he was so brilliant, and it's now over $30 billion. Now, that always sounds good, right? 25 million to 30 billion. Obviously, some of that was new money, but he closed his fund like 25 years ago to new money, and he keeps giving it back. And he had like 50% cash from 2003 to 2007. If he hadn't already had a great track record, he'd be out of the business, right? Sir, I ignored you by accident. One last question? Right.
One last question, we'll have
Right.
a drawing, and then if you want to sit around and ask more questions, we'll let them do that, okay?
Very good, because it's only been about 2 hours. This is Gerald.
During your presentation, you used the term return on capital
Right.
several times. What's your formula for that?
Oh, please. Do you have to? I mean, can't I just throw around a lot of terms without knowing what they mean? Okay, people, I actually have a pretty simple thing there. I actually don't calculate it, but here's what I do. It's like Buffett. Munger turned to Buffett and said, you don't do any of those discounted cash flow analyses you're always talking about. Well, no, No, because if he has to actually do it, it's not obvious enough. Now, he's a math genius, right? So rest of us can't do that. But what I mean is, if I can't eyeball what a company's potential investments are and see whether they're getting returns on it, that is, they're increasing per share cash flow, PE, or something within a reasonable time of the acquisition, I know they're not getting return on capital, right? And it doesn't take brains to do that. Now, on my spreadsheets, do I have an ROC calculation? Sure, I have no idea what it is. I did it 10 years ago. But if I can't look at a CEO and the financials and say that they are allocating capital for high returns, given by whether there are rising per share metrics after acquisitions and other investments in property, plant, and equipment, and so on. And I've gotten to the point, I've done this long enough where I can say, well, they should be buying back shares or paying it to me if they can't do it any better. All right?
Okay. We're gonna have Tom draw out a ticket